Good afternoon to all of you. This is Ranjan from Smart Finance, and in this particular video, I am going to describe the option strategy which you can initiate in the ICICI Bank before its result day. So, if you just look into the result calendar, ICICI Bank is having the quarterly result tomorrow. So similar kind of strategy you can initiate in any of the frontline counter, which is going to uh, give the quarterly result. So here the quarterly result time is very important, uh, and so quarterly result is very important time to make money in the option strategy. So 23rd October they have the result, and today is Friday. So mostly the result related impacts we can see in the ICICI Bank on Monday. So tomorrow we don't have market. 23rd, 24th, 25th it may react. And the stock also very close near to its 52-week high. So we'll form specific option strategy which is going to benefit from this result move. And in Smart Finance option course, always I used to say one thing, that you must not form a simple strategy. So your formation of simple strategy should happen. However, you must not form a simple strategy. Rather, your strategy should have specific aim and complexity. So slightly different type of strategy will form, because many of you will be knowing the name of the strategy, what is a covered call, what is a butterfly strategy and all. But if you don't combine these two strategies, or if you don't form a combination of the strategies, then it is difficult to make money in the option strategy. And as I said to you, in this particular journey from 2005 to till date, Smart Finance generated or conducted many programs in the option domain. So our upcoming program also scheduled in the month of November, wherein live market we are going to teach you on the various intraday concept, and one complete course also we have conducted in the F&O. So here I have explained many complex way or many complex strategy how you can implement in the simplest way. So this similar kind of one strategy I am going to give it now. Similar kind of one strategy I am going to give it to you now. So for strategy formation, we require two things. One, it's a trend analysis. So I am going to analyze the ICICI Bank November future. Because October end we have entered. So November future I am going to analyze for the coming 10 days period. So ICICI Bank 764 level, it is November future, it is trading. I am going for the 10 days calculation. So it says me if it is I'm using our smart IT all-in-one tool here, using the natural constant I have analyzed for the coming 10 days, which is a very correct parameter. It is telling that 767, if it is maintained coming 10 days period, it can go till 744 or minor cycle till 730. If it slips below 758, then it has the tendency to come 700 level or 689 level. So I'll be just looking into these two end parameters and go along with that. Go along with that. So this is my first study I did. So similar process also we are going to, or the similar process I'm going to initiate the strategies. We have a option strategy software also. That strategy software also I will be utilizing. I'm just loading the data and I will be following. The strategy is very simple, and first theoretical way we will understand. So what we are going to do here, two strategies we are going to combine so that our risk will be highly managed. I'm going to form a covered call with ITM put, So covered call strategy I will be taking, and along with that one ITM in the money put option I will be buying, and one widening butterfly strategy I will be clubbing with this strategy. So in the put option. So the strategy name is like this. So if you see the combinations will look like this way. So here I am just forming a covered call. Covered call in the sense I'll be buying the future November, and I'll be selling one 8:30 call options of November. Why 8:30 call option? My trend says that maximum I can go to 8:30 to 8:44. So currently 8:30 call option is trading. So I'll be selling these call options and I'll be buying the future. So this is my covered call is complete. And I required one ITM put along with that. So I am choosing 800 put. So 8:30 call option I sold. Action is sell. Here 800 put I am buying, and my covered call with this is the covered call strategy. Along with this I am buying one ITM put option. So this is by now protected. Along with that, I'll be making one particular butterfly strategy. So butterfly strategy said that, so we are at 760 level. So what I'm doing here, I'm selling a 760 put option, one lot. I'm buying two lots of 750 put option. Why doing? So here depth is 10 points, 750 to 760. I'm giving a 30 points depth and selling a 720 put option. So all these arrangements, why I did. So have a look on here. So what we are doing here? I am 764. I am buying 763. I am buying the future, and I have a 800 put options here. So 800 minus 763. If you make it, we have 37 points intrinsic value, and 800 put option is putting at, I am entering at 59, almost 59. So 59, if I can less it out of this, I have 22 points of time value. So this time value decay can happen anytime if there is a consolidation. To manage this, I am just selling one 830 call option 14 rupees. So my time value part I have managed well. So I have a time value risk of only 8 rupees. So this 8 rupees are multiplied with 1375 lot size. So 11,000 loss can happen if I initiate only covered call along with a covered call along with a put option. So only this part if I take only this part covered call along with a put option. So I will be having 11,000 loss risk, and what will be the profit potentiality? 11,000 loss risk, and what will be my profit potentiality? So 830 to 763. So 830, how you can theoretically calculate the profit? 830 minus 763, so minus 763 plus 14 rupees you have to add here. Whatever the difference comes in that plus you have to make minus 59 rupees you paid for this, and whatever the things will come here multiplied with 1375. So many those who are the option strategy trader, they will be knowing it. So if I just calculate the profit, theoretical profit, if you hold till the November end and ICICI Bank is closing above 830, then this is the profit you will get. So 830 minus 763, so this comes to 67 points. We have to add 14 rupees and subtract 59 rupees. So 22 multiplied with 1375, which comes to 30,000. So 30,000 maximum profit and 11,000 maximum loss. This 11,000 loss, and it is a very good risk reward. So 11,000 loss risk along with 30,000 profit. So what I am going to do here, I don't want to take this 11,000 loss risk in this particular strategy. So for that reason only, I am adding, because post the result, if the results are bad, stock may go down. If stock is going down, I am going to incur 11,000 loss risk. which I don't want to take. I want to be neutral. So upper side I have added specific position. Same side also I should be open in the downside. So for that reason, what I'm doing here, I'm just erasing this thing. So this 11,000 loss risk I don't want to take. So for that reason, what I'm doing, I'm adding one wide wing butterfly here. So if you just look into the wide wing butterfly strategy. So wide wing butterfly strategy, I'm buying 750 put options 2 lots. I'm selling 760 put option 1 lot. I'm also selling a 720 put option 1 lot. You must ask me why 720. So here the trend analysis once we do, so here we are finding out that our second cycle comes to 700 level or 720 level here, 720 to 1713. So may go to the 700 level, we can come out of this strategy. So that is the idea of choosing that 730. So what about the theoretical liability and loss of this butterfly alone? So butterfly alone will be how you will be calculating the theoretical. So currently, if you just see if the 760 above, if the ICICI Bank maintains till November end, so what will be our liability here? So 26.4 or 26 into 2. So this we have spent, we have received 30, again we have received 13 rupees 50 paisa, 13 rupees 50 paisa. So if I can just sum it up, so 26 into 2, I have negative 52 rupees. So this is negative 52 rupees, 52 rupees, negative 52 rupees, and less it from 30, less it from 13 rupees 50 paisa. So I have a risk of 8 rupees and 50 paisa into lot size of 1375. That to also 11,687 rupees of liabilities if the ICICI Bank maintain above 760 till November 2050. Though I am not going to hold it till November 2050. If the ICICI Bank comes to 720, I'll be having the maximum profit here. So my profit will be, so butterfly strategy profitability you have to calculate like 720 to 750, 30 rupees, and again you have to less it by 24. So 4 rupees, 8 rupees you will be getting, and here too 30 you have given, so 30 you have to lose. So that theoretical proportion way. So 730 to 720 if it comes there, then this put option will be having a 10 rupees loss, and whereas 750 to 30 rupees means here 8 rupees profit will be there, so 2 rupees will be your loss and this 13 will be your profit. So 13.5 plus 2, so 15 rupees profit you can get if the ICICI Bank hold to 720 by 25th of November. But do remember, we are not going to hold the strategy till November 25th. We are just doing a theoretical estimation of the profitability. So whatever we are going to lose, a part of that 11,000 we can recover if the downtrend happens, and whatever we are going to gain in this covered call with the in the money put option, that is having 1:3 risk reward. So this combination is completely having two strategies in it, and this complete two strategies having a covered call with ITM input plus wide wing butterfly input. So this combination once we initiate, what happens? The margin requirement 1,46,000 and future is there. Whenever the future moves also, you need to keep some fund for your M2M requirements and all. And whatever the buy sell balance amount is there, so that much of debit also can happen from your account. So that money you can work out. So what margin will be 1,46,000. If only one wing with 11,000 risk is being taken, margin will be 73,000. However, how you will analyze this particular trade's profitability? Suppose what I am doing here, I am showing it with respect to our option strategy software. So I bought the future. I bought a put options along with that. That too also 800 put options I bought. Along with that, I sold a call options of 830. I sold 1 lakh. Along with that, one butterfly I am going to add input. So I am going to sell 760 put option, sell 1 lot. I am going to buy put option of 750, that too also 2 lots. I'm going to sell a put option of 720, that too also 1 lot. So this is what my entire strategy is. I'm going to hold it for 10 days, not till the expiry. So 22nd it is being initiated. If you look it here, so it has a, it is showing that if at the end of 10th day, if it is going to 800, 3,830 level, if you can put it 830, we have here. So 830 theoretically. So theoretical level 5 to 6,000 rupees we can get. But see about the loss part. If there is a stiff correction till 700 below, then your losses is just restricted to 3,000 to 1,000 rupees range, 1,000 to 3,000 rupees. So this is the aim of the strategy. Theoretically, the strategy looks different when 10 days period you hold, that profit and liability parameters will be different. So, but in all the cases, if you look into this, losses has not expanded to a great range. So this is a conservative estimate if it is moved slowly. However, post result, if there is a stiff movement happens, very good movement happen, and there is a IV decay happens, then you will have a great profit with a very low liability. What about the net Greek here? So delta is near zero, and more important factor is theta, the time decay in the options, which is completely balanced, and it is the 5 paisa per day. Net basis, only 5 paisa per day you are losing in the net strategy. So this particular strategy, follow it for this particular result here and see the difference. Though it is a theoretical, though this software's estimations give you 3 to 4,000, 5,000 gain. So there the software has not taken two factors into account: the time decay which will happen, theta decay which will happen rapidly post the result announcements. So what will be the quantum of that decay? So that will enhance the profitability. The theta decay which is bound to happen post result. So that will enhance the profit. So your maximum profitability of 30,000 what we have projected in this part, out of that minimum 20,000 you can encash if there is a great amount of theta decay happens. So once again I will explain this strategy. The strategy is having two components. One is having a covered call with a in the money put. We are buying a future, selling 830 call because that is the maximum we are expecting the price to move. I am buying a 8,800 put. So by this process, this first part of covered call having theoretical 11,000 loss risk along with 30,000 profitability, and to protect or to protect this 11,000, protect this 11,000 or reduce this 11,000 liability, we are just adding one more part of our one more component which is a wide ring butterfly. But if you are okay with accepting this 11,000 liability, you can go only with the covered call with the in the money put option also. So here, this is what the strategy. Keep following and give your feedback post result. And as I said to you, Smart Finance always conducts the most rational programs, practical oriented programs to for the traders. You can get the one such program is going to be scheduled on the 8th November, and this program, do join and experience this thing. And on with this program, we are going to provide you this integrated tool software where we are doing the weekly and intraday analysis and 10 days analysis. So you can do verify how the efficiency of this software, and this program is going to happen in the live market. Live market, in running market, I am going to explain how you should trade in the market. So keep watching this video, and if you like this video, please give a like. Thank you very much. Thank you for your time.